Picture this. You just got your first real paycheck bump. You open a trading app for the first time, and you put $500 into a company because you love their product and you use it every single day. For a few weeks it works. The stock climbs, you feel like a genius, and you start planning what you'll buy with the next round of gains. Then one earnings report comes in a little soft, and that same stock drops 30% in a single day, taking a big chunk of your investing account with it. And the confusing part is, you didn't do anything wrong by most people's definition. You picked a real company with real revenue. You just didn't know what you didn't know. Here's the problem almost every beginner runs into. Liking a company as a customer and understanding it well enough to own a piece of it are two completely different skills. You can love a brand's product, their marketing, and their app, and still have no real idea what their profit margins look like, how much debt they're carrying, or whether their growth is actually slowing down behind the scenes. Most beginners aren't picking stocks off of research. They're picking them off of vibes, headlines, and a tip from a friend or a group chat, which feels like investing but is closer to guessing with extra steps. Part of what makes this so easy to fall into is that you mostly hear about the winners. Someone posts a screenshot of the stock that tripled. Nobody posts a screenshot of the 3 quiet losers that funded the story they're not telling you. That creates a skewed picture where individual stock picking looks a lot more reliable than it actually is, because the losses happen quietly and the wins get the spotlight. This is where the real damage happens. And it's not really about picking a bad stock. It's about concentration. When most of your investing money sits in 1 or 2 companies you feel excited about, one bad quarter can undo months of saving in a single afternoon. And because that money is emotionally tied to a story you believe in, beginners tend to hold on too long on the way down, then panic sell right near the bottom, which locks in the worst possible outcome twice. There's a second, quieter version of this same trap. Some beginners think they're diversified because they own 5 or 6 different stocks. But if all of those companies are in the same industry, they tend to rise and fall together anyway, which means you're carrying concentration risk without even realizing it. On top of that, buying and selling individual stocks frequently can create a tax bill that quietly eats into your returns, since gains on positions held less than a year are typically taxed at a higher rate than long-term investments. Let's put real numbers on this. Say you have $5,000 to invest, and you're deciding between putting it all into one company you're excited about or spreading it across a broad market index fund. If that one company has a rough year, and individual companies do have rough years far more often than people expect, a 40% drop takes your $5,000 down to $3,000. Spread across hundreds of companies in an index fund, that same rough year for the market might only pull your $5,000 down to around $4,300, because no single company's bad quarter can sink the whole thing. Same amount of money, same rough year, a very different amount of damage. And that gap only gets wider the longer you stay concentrated in just 1 or 2 names. Now stretch that same comparison out over 10 years instead of 1 bad year. A concentrated position can absolutely outperform, but it can also go the other way just as easily. And most beginners don't have the experience yet to tell the difference between a temporary dip and a company that's genuinely losing ground. And here's the part that's hard to hear if you're excited about picking your own winners. The majority of professional fund managers, people who research stocks full-time with teams and data terminals, still fail to beat a simple index fund over the long run. If trained professionals struggle to consistently pick winners, the odds aren't in your favor either, especially if you're checking your portfolio 5 times a day and making decisions based on how a stock felt that morning. Even well-known, respected companies can lose their edge over time. Industries shift, competitors catch up, and a company that looked unstoppable for a decade can quietly fall behind in just a few years, which is exactly the kind of thing that's almost impossible for an individual investor to predict in advance. That doesn't mean individual stocks are off limits. It means they need to sit in a very specific place in your plan, not be the whole plan. Here's the better way to think about this. Build your investing plan like a pyramid. The wide, solid base is low-cost index funds that own hundreds or thousands of companies at once. And that base is where almost all of your long-term money should live. Individual stocks belong in a small slice near the top, money you can afford to lose without touching your actual financial goals, because you're treating it as a skill you're learning, not your retirement plan. That way, if a pick works out, it's a genuine win on top of a plan that was already working. And if it doesn't, it's a lesson, not a setback that pushes back your entire timeline. This approach has a name in the investing world. It's often called core and satellite investing, where the core does the heavy lifting toward your actual goals, and the satellite is a small, contained space to test your ideas without putting your future at risk. So here's what to actually do with this if you're just getting started. First, build your core with broad, low-cost index funds and set up automatic contributions before you ever think about picking individual companies. Second, decide on a fixed percentage, something like 5 to 10% of your total investing money that you're allowed to put into individual stocks. And don't let that number creep up when you're feeling confident. Third, if you do pick individual stocks, spread that smaller amount across a few different companies and industries instead of stacking it all into one name, so a single bad quarter can't take out your entire satellite position. Fourth, before you buy any individual stock, write down the actual reason you believe in it in 1 or 2 sentences, so future you can tell the difference between a real thesis and a headline you got excited about. Wealth Nexus Rule. Know your exit before you know your excitement. If you're trying to figure out how to split your money between a solid index core and a smaller stock-picking sleeve, the Smart Wealth Starter Kit walks you through building that plan step by step, so you're not guessing at the split. And if you want more breakdowns like this before you make your next investing decision, the Wealth Nexus newsletter covers exactly this kind of thing every week. Buying individual stocks isn't reckless, and it isn't required either. What matters is where that money sits in your plan. Let your index funds carry the weight of your future, and let your individual picks be the small, contained experiment they were always meant to be. Like and subscribe.